Do you ever find yourself scrolling through social media, seeing friends holidaying in exotic places, buying new cars, or boasting about their latest home renovations? You might start wondering, am I the only one who feels like I'm falling behind with my money? It's a heavy feeling, this sense of not quite measuring up, especially when you're busy juggling work, family life, and everything in between, in your 40s or 50s. But here's a comforting truth. You are absolutely not alone in this. Many people feel this way, and this video is about understanding why that feeling exists, and more importantly, how you can change it and catch up. First, let's talk about why this feeling is so common. For many, formal financial planning just hasn't been a regular part of daily life, perhaps due to procrastination or the idea that it seemed complex or even scary. Ignoring your money can mean missing opportunities and making mistakes that a simple plan could help you avoid. A significant reason many in their 40s and 50s feel strained is that they belong to what's called the sandwich generation. This means you might be raising your own children while simultaneously caring for aging parents, putting financial challenges from two family generations directly on your shoulders. Furthermore, today's economic landscape is different. Many of you are preparing for later career years and retirement largely on your own, unlike previous generations who might have relied on traditional company pension plans. Government policy and workplace trends have shifted, putting more responsibility on individuals to build their financial security, making personal financial planning more crucial than ever. Another hidden factor can be your inherent money type. You might tend to be a saver or a spender, and not understanding your own or your partner's tendencies can lead to friction or unplanned spending. For instance, a tendency to focus on short-term wants rather than long-term needs can subtly erode your financial progress. Sometimes, the feeling of being behind stems from trying to keep up appearances. Many find themselves in debt by spending to appear wealthier than they are, creating a vicious cycle. Perhaps you haven't reviewed your finances regularly, or perhaps haven't completed essential documents like a will or healthcare proxy. Or maybe you've underestimated the future cost of healthcare in retirement, which can be a huge budget item if not prepared for. All these factors, individually or combined, contribute to that overwhelming feeling of being behind. The good news is that it's truly never too late to start. Time can still be your ally if you use it wisely, and you can quickly feel more in control. The first step is to realize you are the boss of your finances. It doesn't require expensive, complex strategies, just a clear understanding of your goals and a plan. Financial planning should be a holistic process, touching every part of your life, not just retirement accounts or budgets. It's about being in control of your money. Start by simply assessing your current financial situation. Create a net worth statement, listing what you own versus what you owe, and an income and expense plan, tracking where your money comes from and where it goes. These tools don't have to be complex. Keeping it simple is key to sticking with it. Estimate values for assets like your home or car using online tools, but don't overvalue personal items. A powerful strategy for managing cash flow is creating money baskets. These are separate savings or current accounts earmarked for specific financial goals. For instance, allocate money for annual bills, fixed expenses, fluctuating costs, variable expenses, or long-term aspirations like a family holiday. This helps avoid surprises. Set clear, achievable goals. Instead of a vague goal like retire comfortably, make it specific. Retire at age 67 with my current income. Or retire at 55 and transition to part-time work until 70. Write these goals down and review them often to stay focused. It's important to decide if a goal is psychologically and financially achievable. Knowing your money type helps you build a financial plan that truly works for you. If you're a spender, consider techniques like waiting 48 hours before a big purchase or setting up automatic savings plans. When tackling debt, prioritize. If you're buried in high-interest debt, consider putting a percentage of your available monthly money towards paying it down, and a smaller percentage towards emergency savings and retirement. Take full advantage of employer benefits, especially any retirement plan match. Embrace technology like direct deposit, auto-pay, online banking, and account aggregators to simplify tracking your money. Life, as they say, is what happens while you're busy making other plans. Financial security is like a three-legged stool: money, health, and mind. A strong financial plan accounts for inevitable disruptions, ensuring you stay balanced. This means building in contingencies for curveballs. One of the most important aspects is planning for the unexpected through insurance. Life insurance replaces financial contribution if someone dies unexpectedly. Health coverage protects against catastrophic medical costs, and disability insurance ensures income if you can't work due to injury or illness. These are not optional extras. They share risk and protect your plan. An essential safeguard is your emergency fund, ideally 3 to 6 months of expenses. This cash buffer reduces stress during job loss or unexpected expenses, preventing you from incurring high-interest debt. If you face career transitions or layoffs, having reduced consumer debt and access to a home equity line can offer valuable options. For those in the sandwich generation, caring for parents requires sensitive planning. Open dialogue about their financial situation can gently lead to understanding their needs. Remember, your role is to help, not necessarily to take over. Professionals like elder law attorneys and geriatric care managers can provide invaluable support. Should you face divorce or separation, approach it with a business-like mindset. Gather all financial information and understand the after-tax value of assets. Seek special advisors like mediators and lawyers. Don't let emotions drive quick, potentially damaging financial decisions. After the death of a spouse, prioritize immediate bills and collecting benefits, but avoid making major financial decisions until you've had time to grieve and reflect. Updating account ownership and beneficiaries is critical. Finally, remember that the plan doesn't need to be perfect from day one. Keep it simple, acknowledge your money type, and be prepared to adjust your course as life changes. Your self-awareness and consistent effort are your greatest assets. Feeling behind with money is a common human experience, especially during these busy years of your life. But it doesn't have to define your future. By taking small, deliberate steps, understanding your financial landscape, and adapting your plan as life unfolds, you can absolutely get on track. Remember, knowledge truly is power. You have the tools and you are capable of building the financial security you deserve. Start today, one confident step at a time.